Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. My name is Jeff Bernier. I am thrilled that you've decided to spend a few minutes today with me and my guest, and I'm going to just jump right into it. I'm really excited about our guest today, and I've got a bunch of questions, so I want to just jump right in. So please join me. I'm gonna welcome on my new friend, Phil Huber, and let me give Phil a proper introduction. So Phil is a managing director and head of portfolio solutions for Cliffwater. Cliffwater is a leading alternative investment advisor and fund manager. Phil is also the author of The Allocator's Edge, a modern guide to alternative investments and the future of diversification, that was published just a couple years back. He has experience as both a wealth management practitioner, and obviously he's an industry thought leader. Phil is qualified helping us design, implement, and stick with evidence-based portfolios built to meet long-term goals and objectives. So welcome aboard, Phil. Great to have you with me today.
It's a pleasure to be here. Thanks for the intro.
Yeah, really, really appreciate it. So this, I told you in the end, when we met, that this is a pretty informal show, but I really like to start with just hearing about you. So do you mind just sharing a little bit about yourself and your family, and then your career path and how you found yourself at Cliffwater?
Sure. Yeah. We'll start with family. Family's most important. So I live here in the Chicago area with my wife and our two young children. So we've got a 5-year-old daughter and a just about to be 1-year-old baby boy. So
wow. You're busy.
Fun times at home. Yeah, it's a great time of life, but we're enjoying it. And then professionally, I actually sort of grew up around this business, that being the wealth management business. My father's still a practicing financial advisor. He started his own independent RIA back in the late 1980s. And then shortly after I graduated from undergrad, I joined the family business, and sure enough, 12 years passed, and I kind of made a career out of it. And within that 12 years, what I recognized within myself was, when you're in a wealth management business, you're advising clients on all facets of their financial lives. And where I noticed my interest and passion lied was really more on the investment side and how we go about constructing portfolios and delivering that investment philosophy to clients. And so that kind of set me on the path, rather than being more of a day-to-day client-facing financial advisor, which I did sort of some of, but really my focus was on leading our investment efforts, and eventually became the chief investment officer of that organization. Like many advisory firms in this kind of day and age, we grew to a certain size where we had to decide, do we want to continue to build this on our own, or does it make sense to partner with a larger enterprise? And so we opted for the latter, and that in early 2020, about a month before COVID, we sold our business to a larger wealth management firm called Savant Wealth Management, where I became the CIO there for almost 4 years, and that was a wonderful experience. And one thing that was sort of happening along that same time was I was writing the book that you referenced a bit earlier, which was this sort of, at least the way I envisioned it, this sort of how-to guide for advisors on how to effectively kind of understand, source, and implement alternative investments, however you define them, for their client portfolios. And really, in the world of investments, I just continued to kind of go down this rabbit hole of alternatives and how that world is increasingly intersecting with the private wealth channel, where historically maybe these were asset classes or strategies that were more the domain of institutional kind of large pools of capital. More and more you were starting to see products and solutions become more widely available to financial advisors and their individual investor clients. And so this was a trend that that was kind of where I saw the puck heading. In particular, I've had a lot of conviction that this structure known as a interval fund structure, and we can talk more about that later, was, in my view, going to be sort of the preferred vehicle of choice as more and more advisors started to adopt alternatives for a variety of reasons. And I kind of fell that type of structure, this what we call an evergreen or perpetual type vehicle, was almost the same inflection point that maybe ETFs were 10, 15 years ago, as they started to gain traction and eventually replace mutual funds as kind of the default vehicle of choice for traditional kind of stock and bond exposure. And so I sort of, you reach a certain point in a career where it's, okay, what's the next challenge? What could be an interesting pivot to make within the industry? And I thought, it might be fun to go scratch my itch on as opposed to being on the wealth management side where I was, move over to the asset management side and join a fund company that's servicing wealth managers. And so I had a relationship with Cliffwater, was very familiar with their products, tons of respect for the organization, and it just seemed like a really great destination and landing spot for me. And I did view and continue to view the firm as a leader in private market investing, alternative investing, and really innovating around this interval fund wrapper. And so joined just over a year ago as Portfolio Solutions, kind of a newly designed role. Really, I think the idea was, let's try to leverage my 16 years of working on the wealth management side of the business, given that is our core audience, that's who is using our funds, and how do I take that prior experience and utilize it in a variety of different ways. And that can come in the form of just thinking around product strategy and positioning for our fund platform. It's producing investment research. I do a fair amount, as you can obviously tell with the book. I enjoy writing and reading and kind of thinking about how to communicate different concepts in different ways. And
Yeah, so you were the chief investment officer at Savant for a season?
That's correct. Yeah. So, CIO at Huber Financial.
So you were looking at these kinds of products from the other side of the desk at that time.
Yeah, that was a lot of what me and my team did was really kind of diligence and understand product landscape. And so I think having that kind of institutional knowledge from that side about, who are the players in these different categories, what are some of the pros and cons of different structures and strategies. And so I think that's just getting valuable for us as we continue to grow our business here.
Yeah, makes sense. So, this show is all about helping people get sort of their actions and resources in alignment with what matters. And I'm just going to ask you a question that's a little nosy. So tell me your why. What is your big why? What gets you passionate about either your work or your life? What would you say is your why?
I really enjoy helping people find simplicity in what at the surface appear to be very complex topics or subjects. It is finance, it is investing. It can get very wonky very quickly. But I think when you can really have those aha moments where you can kind of break things down to their most basic kind of core, principles, I think if you can help someone build a better portfolio that can help them with better probability achieve their most important financial goals by adding certain components. And if the hurdle to adoption is really complexity or lack of understanding, I think just this emphasis on education and doing what I can there to help that is really what a lot of what inspires me in my day to day. I think a big part of that is understanding that communication in our industry that takes place at a variety of different levels, and you have to adapt your messaging and your content and your language to the audience you're speaking with. A lot of what I do today at Cliffwater is interfacing with other CIOs and other directors of research, people that are kind of in the thick of this stuff every day and kind of speak more of a technical language. And then there's communicating with the client-facing advisors that know enough to be dangerous, but still want to understand, okay, what are the key bullet points that my clients are going to understand? And then there's, of course, speaking with individual investors that the reason they hire folks like us is because they don't understand the stuff. It's a second language to them. And so you have to find real-world examples and analogies that can help them understand finance topics in a non-finance way. So it's part of the fun is being able to have that adaptability at different layers. Yeah,
that's terrific. So let me ask. You talked about this a little bit in the book, but how would you define an alternative investment? So what does that mean? What does that mean? I'll let you use your passion of simplicity here and try to explain that to the layman.
The challenge with that term is that it is sort of this catch-all that kind of gets like, okay, everyone understands stocks and bonds and cash, and then you've got all this other stuff. And rather than have them have their own categories, everyone just lumps them all together as alternative investments. And I think that does a disservice because it is a bit of a loaded word, and different investors are going to have different perceptions or experiences that maybe color their thinking around alternatives for positively or negatively based on how they might have utilized them or been pitched them or sold them in the past. So I think part of it is even, despite the fact that the industry is kind of coalesced around the term alternatives, I think the more we can start to like have that go to the background and really think about what are these assets that sit in alternatives. Often you find they have very little to do with one another. And so really understanding what's sort of the thin gray line, if you will, that connects the dots between these assets and more traditional assets that people are familiar with. And what you tend to find is that there's a handful of variables that can kind of take something that might be traditional in one sense, but it makes it alternative in the eye of the beholder. And so one, probably the most prominent would be liquidity. I think most individual investors are used to the ability to trade intraday stocks, bonds, mutual funds, ETFs. They're just used to having daily liquidity across their portfolio. And then you have asset classes that we specialize in at Cliffwater, private credit, private equity, et cetera. And there's other areas like private real estate, private infrastructure. These are the same economic risks as their public counterparts. It's just this key difference is that you can't buy and sell them every day. And that inability to buy and sell every day has led to historical results that have been able to deliver better than public market returns, partially due to compensation for this liquidity premium, where you as the investor are sacrificing, liquidity is an option as an investor. So if you forego that option, you should expect to be compensated for sacrificing that. And so that's one where it's not this, complex asset class that people might assume it is. It's very similar principles and same foundational approach that you can apply to investing in it. It's just a lack of liquidity that you're sacrificing. And so I think when you can kind of connect those dots, it can kind of make things that were on the surface alternative feel less so and more familiar. And these markets have grown tremendously. One of the bigger trends of the last 20 years has been kind of the shrinking of public markets, particularly in stocks. There's fewer public companies today by a pretty significant margin. There's less incentive for private companies to go public and IPO in the way that they maybe used to 10, 20 years ago. And so the size of these private markets that maybe were sort of a rounding error 20 years ago in terms of the global market capitalization of financial assets, they actually represent a much bigger slice of that pie today. So just from a pure, hey, I want to own the global market portfolio standpoint, there's just a strong case to make just simply for purposes of having a wider opportunity set and broadening your toolkit from a diversification standpoint. That private markets can make sense if you can access them the right way.
So I guess in terms of the term alternative, it can mean a lot of different things, but essentially it's anything that's not traditional public market stocks, bonds, mutual funds, ETFs, and so forth. And some of these are not as complex to understand as you might think they are, but they may be illiquid or have other features.
Yeah, or like illiquidity is one. Another that I like to point to is implementation. Let's take a topic like value investing, which is sort of as old as the hills. It's everybody thinks of folks like Warren Buffett and other famous value investors, and this idea of buying something for a lower price than its fundamental or intrinsic value, and that being a source of returns. And so this idea of buying cheap has existed for centuries. Typically, that's been implemented just by buying stocks, being long stocks, and hoping that those stocks, eventually benefit from that value gap closing. Another way to apply value investing is long short, where you say, okay, what if I don't want to take on broad market, sort of beta risk, but rather I like this idea of capturing the value premium. Another way to approach value investing would be through a systematic long short strategy, where you're saying, okay, here's a basket of cheap stocks. Here's a basket of really expensive stocks. I'm going to buy hundreds of these cheap stocks. I'm going to sell short hundreds of these expensive stocks. By going long short, you're sort of hedging out the market risk component isolating this value idea. So it's really the same philosophy around value investing, but implemented through a long short format as opposed to long only. And so that's another variable where something can kind of cross the chasm from being quote unquote traditional to alternative. And then a third would be what I would kind of refer to as old wine in new bottles. And this gets into kind of packaging and fund structure, where folks would mostly assume mutual funds, ETFs, kind of traditional vehicles. But then you take asset classes that have existed for centuries, something like catastrophe reinsurance. Reinsurers, some of the larger, most well-known ones like Swiss Re, for example, they have been in business for, 200 plus years. It's only recently, though, that these types of risks are being packaged in ways that individual investors can access through structures like interval funds. The same would go for like things like private credit. Like lending is, private lending is one of the oldest ways of making money. But up until recently, it wasn't something that outside of publicly traded bonds or loans, investors could participate in. So that's changed a lot too. So packaging is another big theme on what can kind of make something an alternative investment.
Gotcha. Yeah, I want to come back to that in a moment, but let me ask you a question that you talked a lot about in the first part of the book, and that was the challenge to the balanced investor going forward. So at the time you wrote the book, bond yields were really low, and expected returns on equities were pretty not that exciting either. Markets seemed to be pretty close to fully priced, depending on how you measure it. And so, but today, I mean, you can get over 2% real in bonds today, where you couldn't, I don't think, at the time you wrote the book. And so I think a lot of the first part of the book was the reason that you might want to venture out to some of these other categories, because the traditional 60-40 portfolio that we talk about might not be able to give you the return needed to provide a rising income stream over the next 30 years that you need in retirement. Has anything changed on that since you wrote the book with higher bond yields and changes in capital markets, or do you think it's just as compelling?
Yeah, I mean, if you think about the timing of when that came out, the book was published, it was kind of written throughout 2021, came out at the end of 2021 when bond yields were at historic lows. And that was of that 60-40 traditional kind of portfolio, that was probably the more worrisome bucket is the 40, which I think investors would just have a tendency to get complacent over time. And so what's worked in the past, we just tend to assume it's going to continue to work in the future. And so despite yields continuing to get lower and lower and lower as the years went on, the math with bonds is easy. Your starting yield is a pretty good approximation of what you can expect your, call it 10-year return to look like. And as those yields got down, I forget where the 10-year bottomed at in COVID, but it was like sub 1%. I mean, that doesn't paint a very positive picture. So you knew the returns were going to be muted going forward, but people maybe still assumed that there'd be this assumed diversification benefit that, okay, when stocks fall off a cliff, you can count on your fixed income to be the ballast to kind of hold up a little bit, maybe even generate positive returns as stocks go down. And then, of course, 2022 was the big wake-up call for a lot of people, where not only did rates rise quicker and faster than really any other kind of rate hiking cycle in history, you saw these correlations between stocks and bonds flip from negative to positive, which was a big surprise to a lot of folks. Not only that 2022 saw stocks down, 20 some odd percent, but their bonds were not too far behind, double-digit losses in bonds, which is a scenario that I certainly never lived through. And I think most investors had yet to ever really experience this sort of bond bear market. And so I think that was an eye-opening year for the challenges. Then allocation decisions can tend to be reactionary versus proactive. And that's always tricky, where you try to shut the barn door after the horses already have gotten out. But I think it was a wake-up call that, okay, these portfolio construction principles that I've been leaning on for many years maybe don't apply in this new world. And the good news for investors was they had more resources and tools to use to build a more diversified portfolio across various types of alternatives that can maybe pick up some of the slack where bonds were falling short.
Yeah, I guess the question I was asking, but now that prices of bonds fell and yields are high, is it as compelling to diversify away from bonds? I mean, are we
real compelling? I think it's not like a screaming, hey, this is the worst go forward expectations for bonds as it was a few years ago. Things are much more optimistic. Part of that is though the sort of rising tide of yields can actually positively impact other alternative asset classes. I'll use senior direct lending, private debt as an example. Those are floating rate loans, and so as rates went from 0 to 5, the yields on the way those loans are structured is you've got a fixed credit spread above a floating rate floor. So as rates go up, the yields on these private loans go up kind of one for one over time. And so there's other examples of that where certain long short strategies where a lot of the money is held in collateral, like short-term T-bills. Again, that can benefit from rising rates as well. So it's not as much as it's a much rosier outlook, I would say, for fixed income today than it was a few years ago. These kind of rate change environments can also last longer than we anticipate too. I think everyone was assuming that we'd get a lot more rate cuts coming over the next year. And then now that thinking's starting to change, or maybe we're kind of where we're going to be in this kind of higher for longer environments. There might not be that same price appreciation, barring some exogenous, shock to the economy for bonds. So my message from that chapter in the book was never get rid of all of your fixed income. It was make room in the portfolio from both sides for a variety of different alternatives that can be complementary for return enhancement purposes or diversification or low correlation to traditional markets.
So the audience to this show and the people that are my people, my hero, are sort of these mid to late career folks or recently retired folks that have a lump sum of capital that's got to last for 30 years. And they need a rising income stream for 30 years because obviously if history's any guide, prices are likely to go up over time. And are these strategies appropriate to try to help a diversified portfolio generate higher income over a 30-year period to meet these challenges, or are these not appropriate for those types of investors?
I think when you think of the two sides of the portfolio, you've got your growth bucket, if you will, and your income bucket. I think in the income bucket, asset classes like direct lending or private credit, whatever you want to call it, there has been this historical yield premium where these loans have earned, call it a 3 to 4% historical premium above equivalent credit quality public bonds and loans. And so for those that have that ability to tolerate some illiquidity for a portion of their portfolio, that's proven to be a high quality substitute that can improve your yield profile of your portfolio and potentially generate more sustainable income. I think what's also interesting about that category is because these are floating rate loans, they don't have that same interest rate sensitivity or duration risk that traditional bonds do. Not that duration can't be a valuable tool to have in the portfolio. That tends to work really well in kind of recessionary environments. And so I think having an income portfolio that's got a blended approach of public and private and fixed versus floating rate assets can create just overall more resiliency. And again, kind of back to this idea of creating that durability for someone's retirement lifetime. If you can create more resiliency across a number of more potential cycles that we don't know how they're going to play out in the future, I think it just, again, can provide more confidence in these outcomes longer term as opposed to maybe more uncertainty if you're only leaning on traditional assets. In the case of a growth portfolio, again, investing in something like private equity comes with the expectation that you should earn a meaningful premium over public equities over time, not every single year, but over time to compensate for the greater dispersion of returns in that market, as well as the illiquidity that you're sacrificing as well.
Yeah, I want to come back to the allocations in a moment. But what I wanted to ask you first was, okay, so if we say, okay, we need some of these alternative types of asset classes or diversifiers or whatever term you want to use for these non-traditional products, how much is needed to be meaningful enough to make a difference in a portfolio? Is there like a minimum threshold where if you're not going to do any more than that, you might as well even bother? Or is there any rules of thumb on that or thoughts on that?
Yeah, I think there's a couple ways to think of it. One is, well, what you don't want to do is sort of add something in to check a box just to say you have some, and then you look, it's like 1 or 2% of the portfolio. That's not going to make a huge difference or move the needle much. So I always like to say there's not a right answer, but it should be enough to make a difference, and you feel the impact, but not so high that you're potentially introducing too much illiquidity risk or too much complexity risk for an investor that maybe isn't yet there in terms of how they understand it. And again, the more alternatives you have in a portfolio, the more differently it is going to behave than the benchmarks or indexes they're seeing quoted on CNBC or what their neighbor's portfolio looks like. So if you have an investor where there is that behavioral risk component where they don't like to look too different from the market, even if that different portfolio is a great portfolio that can deliver great outcomes, it can be tough to hold during certain times as well. That's sort of the catch-22 with diversifiers is they can be really valuable, but when you have more line items in a portfolio that have different sources of risk and return, you have a higher probability that at least one of those is going to not be doing so great at any particular point in time. And so I like to think of it as you may be creating a higher likelihood of winning the war, but you have to go into that knowing that you might be losing a few more battles along the way. And by battles, I mean just there's always going to be something sticking out like a sore thumb in your portfolio. If everything's moving in the same direction at the same time, you might have a lot of line items. You might look diversified on paper, but you might be diversification in name only, and you might be more correlated than you think.
Yeah. And you have to manage the behavioral side. So, but there's no percentage that you would say as a minimum?
If we're looking for sort of a range, I would say what we tend to see for folks that are incorporating various types of alternatives, it's kind of in that 10 to 30% range. 30 being at the high end, but maybe most kind of aggregating in that kind of 10 to 20% range. Again, and then some of it has to do with like what is the objective of the portfolio, what type of allocation, because that not only influences the total percentage, but within that, call it 20%, what types of assets are being used. For a conservative investor who's focused on downside protection and risk management, private equity might not be the best sleeve in that alternatives bucket for them to focus on. Similarly, for someone who's got a very long horizon, a great appetite for risk, they might not need the income stream that comes from private debt. And so they might. So again, it's a bit about the percentage, but it's also about what are the components and where are you sourcing those from.
So is there a similar question? Is there a minimum portfolio size where it would make sense to put 10 to 30%?
That used to be a more important consideration years ago. So there's a number of different qualification levels for different types of investments that advisors and investors need to be kind of mindful of. There's a lot of investments that anyone can invest in, but then there are certain types of asset classes or fund structures that have limitations on who can invest. And so you have something that's called the accredited investor definition, and there are certain funds that are only available to those that meet those requirements, and that's in either or of an income-based threshold or a net worth requirement. In the case of accredited investor, that's $1 million of net worth, excluding your primary residence, or I believe if you're an individual, that's 200,000 of income in the last 2 years, or if you're married filing jointly, 300,000. So if you can meet either of those thresholds, then you're deemed to be accredited. A more stringent requirement is something that's called a qualified purchaser, which is a minimum net worth of $5 million, excluding net worth. When you think of private market type of asset classes historically, and these limited partnership structures that are long lockups, K1, tax documentation and reporting, those have tended to be only available to folks that meet that qualified purchaser recommendation. So to your question, this is not the case today as much, but 10 years ago, say, it was really tough for the sort of millionaire next door type investor to even if they wanted to really access any kind of high quality private market solution, because if they didn't meet that net worth requirement, it was sort of just not available to them. That's changed dramatically. That's a big part of, again, why I came over to Cliffwater. I think us and a number of others have really innovated in bringing these solutions in a high quality fashion downstream so that more and more investors can participate at lower qualification thresholds.
I'd love to get into that because, years ago, and this is again back to the branding of alternative, we thought, we thought we wanted liquidity, we wanted low cost, we wanted transparency. And those products were like 2% management fees, and 2 and 20, right? And 20% of the appreciation or whatever. And at the end of the day, it looked like all the management was getting all the extra return. You might get extra return, but you weren't getting it because of the internal cost. So you're starting to talk about interval funds, and this might be a good time to talk about what has changed since that old world in terms of making this more accessible to more normal people.
Yeah, we'll start with we'll call it the old guard. Might sound like an oxymoron, but the traditional way of investing in alternatives, which is through these what they call drawdown funds or limited partnership vehicles. And if you think about the experience for the investor, what happens is you'll commit, say, $1 million to a fund, and that manager will then call that capital over a multi-year horizon. So say 3 to 5 years, they'll be intermittently calling some of that capital. So they're not going to take your $1 million all at once. We're going to say, every once in a while, hey, we got a new company we're investing in, we'll take 100,000 of that now, or 50 grand, or what have you. And so basically what happens is you've got this bucket of cash that you've committed. You got to decide what to do with it until it's called. You can park it in cash, but that's going to be a drag on returns. You can invest it in bonds or other short-term assets, or you can invest it in the stock market. But it's not the onus is on the investor to determine what they do with that committed capital that has not been called. So that's the investment period portion of the life cycle of these funds, and these are what they call finite life funds, meaning a mutual fund, you can buy it today and own it as long as you want to, and you're never in a position where you have to sell. The fund's not going to wind down. Private funds historically have been different, where they're typically call it a 10 to 12 year life cycle. So that I mentioned that first kind of 3 to 5 years, the investment period while all your capital is called. That introduces what's called the J curve, meaning you're really not going to see any return on that money until at least years 5 and beyond, meaning it's going to just look like, because you're paying fees on that committed capital. All they're doing is, kind of taking it from you. You have to have a lot of patience because you're not really seeing any benefit until the latter part of the fund life. And so that's why they call it a J curve, because if you start flat, it basically you kind of start negative in the early years, and then eventually as the funds start to distribute, they start to sell portfolio companies, they will then distribute that back to investors. And that's kind of known as the harvest period. And so what you're signing up for in that type of structure is essentially at least a 10 to 12 year commitment before you can expect to get the majority or all of your money back. And that's a tall ask for a lot of people that maybe aren't used to that. That's and so that's why people can maybe get a little bit skittish. The minimums have tended to be quite high for those structures that, typically at least $1 million or above. And one of the big things that we always preach at Cliffwater, because our background before we started managing funds was we were a consultant to large institutions on how to allocate to alternatives. So think pensions, endowments, those types of organizations. And what we preach to them when they're building a private equity program for their portfolios is you want to have a lot of diversification, because you could drive a truck through the gap between the best performing manager and the worst performing managers. And you also want to have diversification by strategy, by what they call vintage year, which is essentially just the year that a particular fund is raised. And so to get that degree of thoughtful diversification requires investing over a multi-year horizon across many different managers. So that if you've got $1 million minimums just for one fund, to try to do it the right way and get kind of exposure to dozens of funds over time, you got to have a big wallet to write those checks. That alone has kind of kept it off limits. And then the other things that have just been kind of what I would call inconvenience features of that structure for the average individual is, it's not a ticker symbol that you can go buy at Schwab or Fidelity. So you got to fill out lengthy documents, lengthy paperwork, sign a lot of documentation. It's just, reporting is more challenging. So there's a lot of reasons why individuals have stayed away from that world, and it's been less because of the attractive attributes of the investments themselves and more about, hey, the return on hassle is not there for me, given all the other burdens I've got to bear to make this investment, tax, operations, etc. So what's really changed is what interval funds and other certain structures like ours are doing, which is how do we make it easier for investors to transact in these markets. And so what's novel about the interval fund is, as opposed to that finite life I mentioned earlier, interval funds are perpetual or evergreen in nature, meaning the investor has more control over when they enter and when they exit. They are not put in a situation where they're going to be distributed all their cash back at some point and then have to figure out what to do with that and go into the next fund. They can have more control over their investment time horizon. The minimums are lower. So in the case of our funds, the individuals coming in, there really aren't any meaningful or restrictive investment minimums. The tax reporting is just much more friendly. It's 1099 tax reporting versus K1s, which makes it easier for everybody, including their CPA. You have periodic opportunities for liquidity. So as opposed to having to get your liquidity back piece by piece over 10 to 12 years, it depends on the fund, but interval funds generally will offer either quarterly or semi-annual opportunities for investors to redeem. The caveat being is that, okay, you've got illiquid assets. You don't want to have too big of an asset liability mismatch between the assets themselves in the fund and the frequency of liquidity that you're providing. And so the way that interval funds are structured from a regulatory and kind of legal standpoint is we are required to repurchase at least 5% of outstanding assets in those intervals. And so we have 3 funds. 2 of our funds we offer quarterly liquidity. 1 we offer semi-annual. At those intervals, hence the name interval fund, it is our duty to provide at least that 5%. So in other words, if less than 5% of the aggregate investors in the fund seek to get out in a particular period, then everybody gets 100 cents back on the dollar. If more than 5% of the fund wants to get out at a given time, then each individual investor is prorated by that amount. And so there is always this opportunity for partial liquidity. We try to encourage advisors and investors to really think about these as long-term funds and long-term vehicles. So despite that periodic liquidity valve being there, think of it more as a safe, break glass in case of emergency. Don't always assume that it's going to be there.
Or it could be gated. I guess gated is the right term. Yeah.
Yeah, we say prorated would be the term. So it's never that we can shut off.
But if I'm the only one that wants a distribution, I can liquidate the whole position if I wanted to.
Yeah, as long as the collective amount of investors that are seeking to redeem in a particular period is below that 5% of the total asset value of the fund, then everyone gets 100 cents back on the dollar. And so I think that gives investors a lot more comfort in entering these asset classes, just because they don't have to deviate or step too far away from the types of structures that they're most accustomed to. The other benefit I didn't mention yet for interval funds is they trade with a ticker symbol. So you can go purchase it at through advisors, not directly as an individual, but in terms of how the transaction take place. There's no filling out of paperwork. It's just in a lot of ways kind of looks and smells like a mutual fund. The key difference being that limited liquidity on the sell side. So often you can come into an interval fund on a daily basis,
any day, yeah.
But it's that selling liquidity that is more limited, and that's by design. Yeah.
And can you purchase it at like major custodians like Schwab or Fidelity?
Fidelity, Pershing, all the majors.
Okay,
correct.
so they have so it's like any. And what about the daily pricing? Are they priced daily, or are they priced just quarterly when you're getting ready to offer redemptions?
They are priced daily. So if you have a fund that is letting people in daily, you have to publish the daily net asset value. And so so that's another sort of innovation that's happened in the space is the underlying assets themselves. Those are, think of those as investments we're making with private equity managers. They send us updated valuations on those on a quarterly basis. On kind of a rolling quarterly basis, we'll receive updates from the managers, and those get reflected in the fund's NAV, they call it, net asset value. But we also have to be mindful of, okay, there is some correlation between public and private equity markets or public and private credit markets. We don't want to ignore what's happening in public markets, especially in a very volatile period. So in addition to the quarterly marks that come in with kind of a lag, we apply in our funds what we call like a daily beta adjustment, meaning we've analyzed historical sensitivities of, say, private debt to publicly traded loans, or for private equity relative to publicly traded stocks. And we apply a modest beta adjustment on a daily basis, meaning if markets are trending upward or trending downward, we'll be kind of following along to a degree as well inside of our fund, just to again, not have that potential for stale prices and this sort of valuation cliff when private markets catch up with public, because there is that lag.
Yeah. Well, I mean, that's the danger, I guess, is, some gamesmanship in the valuation. And this is probably not going to be fair, but I'm going to ask you a hard question here. You may have seen, I don't know, a couple months ago, Jason Zweig at the Wall Street Journal wrote a pretty negative paper on interval or article on interval funds. And obviously the sales pitch that a lot of people are getting with brokers. Cliff Asness, who wrote the foreword to your book, has written a lot of things recently about he's not a big fan. It doesn't sound like, and again, they're painting broad brushes here. So I know that's not fair, but I did want you to address it just because I might get questions about it. And then finally, I mean, this is sometimes you think it's coming from from agendas, but other investment managers that don't have interval funds, argue that you could accomplish the same thing in these alternatives with private market equivalents and leverage. So that's a lot I just threw out, Phil. What are they missing? What are these guys missing, do you think?
Yeah, I think I would never want to put words in Cliff's mouth. I know that's
that would be dangerous.
Yeah, it might be dangerous for my health. But no, I obviously love Cliff and have a ton of respect for him. Yeah, I asked him to write the foreword for my book because his writing and research over the years has been highly influential in my own shaping of my investment philosophy and how I've kind of gotten to know the world of alternative investments. And without putting words, I don't think Cliff necessarily hates private equity or private markets in general and thinks they're bad asset classes that you shouldn't own. I think where he's maybe taken a different view is that he just doesn't think that the pricing is as reflective as it should be relative to what's happening in public markets. And there's arguments on the other side of that as well, that if there's research that's been done to show that private equity managers are actually pretty conservative with how they mark their portfolios. But there is that inherent lag component where you have assets being valued on a let's say a quarterly basis versus the intraday volatility. So in a way, public markets should be more volatile because they're on public markets. People transact. These private equity managers don't have to buy and sell these assets every day. I think what we're doing in having those daily beta adjustments is, in my view, a better approach because we are introducing some of that public market volatility there with those beta adjustments. Given the fact that we do run a vehicle that offers a daily, NAV and that we're letting people in on a daily basis and letting them out either quarterly or semi-annually. So I think you have to have some kind of adjustment there. Whereas in a true private illiquid fund, they don't have to do any kind of intermittent valuation updates. They can just do it on a quarterly basis with whatever kind of lag that they have there. And so, yeah, you're always going to see that lag effect. And I think that's normal and should be expected. I think where we would disagree is that some folks might take that lag and assume that just means that the private equity managers are burying their head in the sand like an ostrich and not paying attention, never marking their books. And that what we've seen in practice is that that's just not the case. You still tend to see when private companies are sold by private equity managers, you're still seeing, a material pop and exit, whether that's through an IPO or some kind of merger or selling to another private equity sponsor. If it were the case that they were if they were marking their books too aggressively, meaning valuing these companies too high, then they wouldn't be getting these substantial premiums at exit relative to where they were holding those.
What I interpreted from at least the Zweig article in the journal and a lot of stuff that Cliff Asness writes about is the way they're sold. They're just not communicated properly. They're sold for the wrong people for the wrong reasons. And of course with Cliff, I think it was, if you're arguing, that there's low volatility because you just didn't price it very frequently. Well, that's not accurate. I mean, prices do change whether you priced it or not. So I think it was really a function of the danger in selling them as low volatility instruments, when in fact the reason you had low volatility is they weren't priced. Nobody appraised them.
If you have a vehicle with a daily NAV, you statistically have a standard deviation of returns. What we would say is we would not view standard deviation as the best measure of risk for the asset classes that we're offering. It's not. So when we have communications and conversations with advisors, we're not selling them on, hey, look at this low standard deviation here. There's no, we're very transparent that these are risky asset classes. In the case of private debt, this is, you're not being paid historically what's been a 6 to 7% yield premium to T-bills. That's not a free lunch. You're bearing
credit risk.
You're bearing credit risk. You're susceptible to the broader macro and credit cycle. The risk in that type of investing is a prolonged period of excess credit losses. You think you're more than compensated in the yield that you're receiving for, what that potential for credit losses has historically been over time. And we have a lot of data. We have our own index that now goes back 20 years and kind of shows how the asset class has performed in different cycles. And so we think that's despite that being the risk, we think investors will be compensated above and beyond that over time. But there is risk there. We don't shy away from that.
The comment you just made brings me back to something you said earlier about the allocation. So let me ask that now. So private credit in particular, I mean, you are taking economic cycle risk like you do with stocks. So if you're going to allocate to private credit, do you take it from the fixed income sleeve? Do you take it from the equity sleeve? Because again, to me, it's like a high yield bond in terms of the credit quality.
In terms of where it's gotten slotted into portfolios for a lot of investors, for those that had a pre-existing allocation to, say, high yield bonds, so this is for your listeners, non-investment grade bonds, because that's what private debt is these are typically not investment grade loans. What we found is the allocation to private debt sort of crowds out high yield bonds because high yield bonds have this moniker historically. They call it kind of chicken equity. It tends to trade with stocks, when they go down historically. So it doesn't have that diversification benefit that treasuries or investment grade, bonds have offered historically. And so there's more downside risk, and that's why there's been the higher yields. Private debt has actually been more stable. And we think it's proved to be a better diversifier. I think particularly with credit too, there's ways to construct a portfolio where you do mitigate some of that risk inherent in the asset class. Because the way we think about it is, yes, there is credit risk. There's risk for companies to go into default, to go into bankruptcy, where you know what your upside is in the asset class. That's your yield. Your downside is hey, things don't work out sometimes, and companies go out of business, and then the lenders don't get paid back. Where you tend to see big, blow-ups, if you will, in credit is what I kind of think of as the cocktail of high leverage and high concentration. Meaning not only are you making these loans, but you're levering your fund significantly, and you might have a small subset of loans where maybe a handful of those loans represent a big chunk of the fund. And if one or two of those go bad, then you've got, a situation on your hands. We think about investing in direct lending in a very different way. So we do not originate loans at Cliffwater. We partner with dozens of different what we view to be high quality A-rated lenders. If you think about, this universe of an asset class, there's over 330 direct lenders in the market. Our research, our due diligence, our manager relationships, we think about 50 of those 300 plus are what we deem to be A-rated, kind of top quality institutional managers. And what we try to do in our fund is work with a large subset of those on largely a fee-free co-investment basis. So the majority of our portfolio are these kind of fee-free direct loans. That allows us to keep our overall fund costs low. And what it does is it allows us to create a much more hyper-diversified portfolio than any of our peers that are single managers can do. So because we're working with dozens of lenders, it allows us to create a fund that takes on a lot of the characteristics of an index fund, where you're getting that broad market exposure. You've got thousands of loans. No individual loan comprises a meaningful portion of the fund, and so you're not completely. You can never diversify away the credit risk, because that's like sort of like the market risk. But by keeping your leverage low, your costs low, and your diversification broad, you can create a structure that, in our view, just will tend to be more resilient across market cycles and not be subject to blow up risk if and when there is a material credit event.
Yeah. But again, you are taking credit risk. So if you thought about fixed income as defense, this would still be probably considered offense, like high yield bonds.
Yeah, and I think so. We see some folks where they'll kind of split the allocation. Maybe say 2/3 of it comes from bonds, a third from equities, because it does have that potential for correlation in extreme environments. So yeah, you see it used a variety of different ways.
Gotcha. Our philosophy's always been around low price relative to fundamentals, value tilt kind of thinking. And right now, there seems like a lot of interest in private credit and private equity. So I guess my concern might be that is it over harvested at this point, or overgrazed, or is it? So is the expected returns really low right now because it's so popular and a feeding frenzy for these categories?
You don't think so? We think our capital market expectations for public stocks, looking out, call it the next 10 years. In fact, we just published our annual allocation report that we do every year, and we're kind of looking at kind of for public stocks, kind of mid-sevens returns is what we expect, and we expect, and this is consistent with history, is about a call it 3 to 4% premium for private equity above and beyond that.
Even at today's credit spreads.
So for credit spreads, so for private credit, you're saying?
Oh, I'm sorry. You were saying private equity.
Yeah,
okay.
Yeah, I was on the equity side. So shifting over to private debt. So there was a sort of golden moment a couple of years ago where base rates were, kind of peaked out at, call it 5.5%, and spreads were, credit spreads were maybe about 100 basis points wider than they were. So then, that was an environment where in our index, if you will, you were getting kind of these 12% type annual returns. That's at the high end of what you probably can expect to get out of private debt. Our return expectations are still kind of low double digits for private debt, or maybe kind of 9 to 10 as we look out over a longer term horizon. And that's just a function of, again, the base rates have come down. We've had a few interest rate cuts. Credit spreads have come in a little bit, but they're not tight by historical standards. They're just not as wide as they were. That's not necessarily a bad thing.
Yeah, but those are equity-like expectations.
Yeah, the returns have been higher the last couple of years than average. The longer term expectation we have for the asset class is, call it 8 to 10%, kind of net of fee returns. We think is a reasonable assumption there. As much as everyone would love 12, 13, 14, 15 in a all else equal, what you got to keep in mind in private debt is, as those floating rates go up, somebody's paying that. You have a borrower that was paying maybe 7 or 8% a couple of years ago, and now they're paying 12%. Maybe they can withstand that for a while.
Yeah, they could go out of business because they got to pay that.
So what you see is there's this correlation as returns go up from higher base rates. It does introduce a little bit more stress into the borrower universe, where maybe their interest coverage ratios are not as healthy as they were, in years prior. And so, with more muted return expectations, with rates coming down, maybe that means we're not going to get a repeat of the prior couple of years. But what that does is, I think what it leads to is a borrower cohort, or just kind of better overall portfolio health, where there's a little less strain on the borrowers. They've got more, if they're paying less in interest costs, they've got more cash they can use for other purposes to run their business. And so the two sides kind of do go hand in hand with one another, where as the returns come down, so too does the risk in our view.
You talked about this earlier when you talked about the dispersion of returns between private equity managers. There's a big, broad dispersion between the best managers and the worst managers, and you don't know that till later. So, you won't know whether you had the best or the worst or something in between.
That's a very different risk in private equity that you don't necessarily have in public equity, because If you think about, public equities, you and I and every individual investor in the world has the same opportunity set. We can all go out and purchase the same stocks. We can buy the whole market very easily. There's no Vanguard total private equity market index fund that you and I can go buy where we just kind of own the market. And so your experience in private equity is a reflection of your manager sourcing, evaluating, and underwriting abilities. That can mean really, really good outcomes, or it can mean not so great outcomes. And so that's, I think, where we want to, what we deliver across our funds is exposure to many different managers, because I think one of the risks that investors take on if they try to do it directly with a single manager is that they have this adverse selection bias where maybe the person that's coming and pitching them on investing directly in their fund is only going to them because all the other institutional investors said no, and that this is their last on the list. So there is that adverse selection component. At Cliffwater, we've been in business now over 20 years. We've been investing in private equity for that full 20-year period. And with that comes a great understanding of who are all the players, how do you have the right relationships. It is still very much a relationship-driven business. So having that history of sourcing and evaluating and vetting managers, I think puts groups like us, and not just us, we have some great competitors as well. That again, I think that if you're an advisor, that's what you want to do, is you want to find a trusted partner that can gain you that broad access to high quality private equity managers without having to bear that burden yourself.
And you've got a bunch of them. You don't have one manager in the quote evergreen product, correct? You've got multiple. Yeah. I mean, that's the challenge, I think, because if you're, I've spent the last 20 years, trying to do this evidence-based approach that says in public markets, active management doesn't really pay for itself. And then I see the compelling argument that, the small cap premium was different because a lot of these companies aren't going public anymore. So I may not be getting a small cap premium or a small value premium or whatever because these companies don't go public. So if I see the case for trying to get the asset class, I just want the asset class return. I don't want to make a bad manager selection and wipe out the benefit of the asset class. And that's kind of what you're telling me, I think, that you're trying to accomplish.
Back to one of the early questions you had, like kind of what gets me up in the morning. It's this idea, how do we create simplicity from complexity? And that's how we think about our product suite is, clients want, they say, okay, I buy in. I think private debt and private equity should be a material part of my strategic asset allocation for my clients. I don't want a bunch of complexity under the hood. I don't want them having to see 10 to 15 different line items on their statements and all this operational kind of mess that they've got to deal with. And so that's the idea, is how do you create this sort of iceberg type analogy that I'll use, which is, simplicity at the top. What the client experiences, they see I this other analogy better I'll use, which is a duck floating along a pond where it looks very calm above the surface. That's the client experience we want to deliver with our funds. But that duck is just, spinning its legs like the Dickens underneath the water. That's what we're doing inside of our funds with all these manager relationships, all these different transactions, all that complexity. The idea is that you as the advisor, you as the investor, what you see is that top level kind of simplistic view where you can get a comprehensive allocation across these major asset classes in an elegant, diversified fashion.
Yeah, but for me to be calm up at the surface, I've got to know underneath that I'm not going to blow up because of one manager. I'm going to get the results that I should be getting in the asset class, because that's really what I'm trying to do in the lowest cost way I can do it if I believe there's value in the asset class. I just got a couple more, Phil. You've been really generous with your time, and this is some really helpful information as we start educating people on more opportunities and, again, challenges with more robust portfolios that can withstand all types of different economic outcomes. Because we've had a pretty good century, and it's not guaranteed for the future.
Hopefully another good century ahead.
I'm hoping for me and my kids and yours and yours. So talk to me just a moment about real estate, private real estate versus publicly traded REITs that I can just buy on the market. So can I get the same benefits in public REITs as private REITs? or is there value for being in the private space?
I think there can be value to both. I think what we talked earlier about sort of the lag of pricing updates in private markets and how they tend to follow what's happening in publics with a lag. That lag tends to be most pronounced in real estate, where you might have buildings or properties that get appraised on an annual basis versus more kind of quarterly valuations for things like private equity or private debt. So that's probably got in our research the biggest gap between public and private in terms of that lag effect. It doesn't mean private real estate's not worth owning. I would say we've, as a firm, been relatively bearish, if you will, on private real estate for the last couple of years, but that might be starting to change. It seems like we might be approaching, at or near a bottom where things might start to, reverse the other way, and maybe there's brighter times ahead for the world of commercial real estate. Commercial real estate is a much broader universe of property types than most imagine. I think we tend to gravitate or think about kind of the four basic food groups of, office and retail, industrial, multifamily. But then you've got all these alternative property types, medical office, self-storage, student housing, data centers, cell towers, et cetera. There's a number I'm sure I missed there. But what's interesting is that the sector composition in public and private real estate is very different. I think in private real estate, you tend to see more of the more traditional property sectors. If you look at like an ETF like the VNQ, that's Vanguard's kind of real estate, public REIT index, and you start to look at the top holdings there, it's these large, data center REITs or cell tower REITs or kind of other specialty type REITs. And so you get different sector makeup. So that to me is a reason to think of them not as an either or decision, but I think you can have benefits to having some exposure to public real estate and private. Some of it might depend on investor objective. With public real estate, you're going to get a lot more volatility, and while there is going to be a yield component,
there's going to be some market result regardless of the underlying property.
Yeah, you're gonna have a beta, broader beta influence on that as well. And it's going to be more total return over time. So if you have like a more income oriented investor, real estate exists on a spectrum. You've got kind of four strategies, we'll call it, which is sort of core, which is stabilized property, almost all income driven, core plus, kind of a step above, value add, and then opportunistic, which is kind of more development where it's higher expected return, but obviously commensurately higher risk and kind of more equity like in nature. So even within real estate, you've got risk profiles that vary from something that could fit inside of an income sleeve and be more of a diversifier to something that might be more appropriate for an equity bucket as well. So a lot of it gets back to investor objectives, attitudes around illiquidity, but I think purely just from a sector exposure standpoint, you can, I think do some good by blending the two approaches.
Yeah. Well, so you didn't talk at all about any illiquidity premium for private. Is there in real estate?
It has not been as pronounced. And maybe that's somewhat due to the sectoral differences that I just mentioned. But yeah, at least in the data, again, there hasn't been that same premium to private real estate for that illiquidity. And again, maybe that's just a function of it being a shorter data set. Maybe a particularly strong, period for public REITs where a lot of that returns driven by the rising tide of the stock market and an impact that's had on that. So, kind of hard to circle the square there a little bit because it is a little bit of an inconsistency with what we've seen in these other markets, but something worth certainly paying attention to.
Gotcha. Okay. Well, the last big question is really about tax efficiency and placement in portfolios. So if I painted a picture for you and said, okay, someone's going to use alternatives or these non-traditional products, and they were going to use private credit, private equity, reinsurance, and private real estate, how would you rank those in terms of what would we start in the IRAs versus taxable? Is there a hierarchy that you would think about on that, or not?
Where you can, you want to probably hold private debt inside of an IRA or some other, tax deferred account. Because, we won't say 100%, but close to it will come from the return of the asset class will come through ordinary income distributions, and particularly for higher tax bracket clients that can help them keep a lot more of that return if they don't have to pay, a big chunk out to Uncle Sam. I would say from those 4 categories, then reinsurance, I would probably say would be another candidate for a tax deferred account.
Yeah, because like bond like yields
Yeah.
as well. Yeah.
Private real estate can have some very attractive tax benefits. It might vary a bit by the structure, but I would say that's probably one where folks tend to want to own that in taxable accounts because they can benefit from some of the preferential tax treatment that real estate receives. And then private equity, I would say it's going to be fairly tax efficient as an asset class, generally speaking. It's not going to be like a Vanguard, index fund.
Of course. Yeah, there will be some turnover.
Yeah, but I would say given the long horizon nature of the asset class, you probably shouldn't expect a ton of short-term capital gains. So I would say, from a spectrum standpoint, it's going to be certainly not as tax inefficient as private debt, but not as much maybe as public equities, particularly if you're indexing or using ETFs. And so maybe somewhere in the middle, but perfectly appropriate, I think, for a taxable investor.
Yeah, I guess what I would say on the private equity part as well that might argue for taxable is of those 4 choices, it's expected to be the most volatile. So there would potentially be more tax loss harvesting opportunities in private equity than you would.
That is true, but at the same time, you don't have that daily loss harvesting ability you would have.
Correct. I mean, you're still looking at semi-annual probably with most managers.
In my prior life, we saw some advisors particularly for like evergreen private equity structures as a Roth IRA tool where
high expected returns,
asset class, long horizon, et cetera. So. But yeah, I think asset allocation, within alternatives, generally speaking, asset allocation, if you've got a healthy mix of account types, you want to certainly try to optimize to a degree around that so that you're not housing, tax inefficient stuff in the wrong account types, et cetera.
Yeah. Well, Phil, this has been really helpful. I really appreciate the information. This show is pretty broad. I mean, I'll have some people on here and we'll sing Kumbaya and talk about meaning and purpose and the meaning of life and how to go live a great life. And then we'll marry it with how do we build financial plans to get us there. And really my goal with our conversation was just to make sure that people understand that the world may be different in the future than it was in the past. And we may have to think differently. We may have to expand our horizons a bit.
Yeah, I always come at it from the standpoint of like if you were to come in with a blank slate or a blank whiteboard today, knowing what you know about building portfolios, about the types of strategies and vehicles that are now available, it is a very different world today. And so I think if you were just kind of clearing the slate a little bit, you might approach asset allocation differently than you historically had. So I think that's a good exercise to periodically go through, is to say, to not just get too tied into, hey, here's how we've always done things, but is there an opportunity to innovate or do things a bit differently that can help us and our clients achieve their most important financial goals?
Yeah, terrific. Well, is there anything that I didn't ask you that you wish I had, or is there anything else you wanted to share?
We covered a lot. Maybe if
we did.
I'd love to come back on at some point. Maybe we can have a more less technical, more of a softer conversation around.
Oh, that'd be good.
Meaning of money and all that fun stuff. So
that would be awesome. I'd love to do all of that. Well, you've got a great blog for people that want to kind of geek out and get a little bit deeper in some of these things. So tell us how people can find your blog as well as follow you on other channels where people can keep up with Phil.
Yeah, so my blog is called Bips and Pieces. I've been doing that for, I want to say 8 or 9 years now. So it's bpsandpieces.com. That's also my Twitter handle. If you're on Twitter, I guess I still don't call it X. But at Bips and Pieces there. I'm pretty active on LinkedIn as well, and just kind of easy to search and find my stuff there. And then, we publish a fair amount of research at Cliffwater. So our website is cliffwater.com, and myself, our founder, Steve Nesbitt, others occasionally, we publish a lot of white papers, things like that. So if you're a junkie for those sorts of things, then hopefully it'll be right up your alley, but would direct you there as well.
Thank you so much. Thanks for sharing all that. I'm would encourage people to check out Phil if you want to learn more about some of these ideas and in what he's about and what he's and again and simplifying the complex is a lot of what you'll find in some of his material. So, and also check out his book. I'm gonna have to encourage him to do an updated edition now because the world has changed a little bit. But it's really good information. If you want a deep survey on these types of asset classes, the Allocator's Edge is a really good one.
I might be due for an update one day. I might have to wait till our second's out of diapers.
Kids get a little older.
Yeah. But we'll see.
Yeah, very cool. Well, thank you guys for joining us today. I hope you found this intellectually interesting as I did. I'd been looking forward to this for a little while, so you can tell that I was prepared with to try to go a little deeper than we do on some of these calls or some of these podcasts. But anyway, thanks for joining us today. You can check out the podcast wherever you get your streaming. Please give us a rating and share it. And if you want to communicate with me, the best way to do that is either through our corporate website at tandemgrowth.com, or you can email me at moneyandmeaning@tandemgrowth.com. So thanks again. Have a great day. Take care.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.